evening and welcome to The Money Show, the only daily show of its kind which brings you the market's top financial experts to answer all of your financial queries. I'm Avni Raja. With me is Avan Dubash.
Well, hi Avni and hi to all of our viewers. Yes, exactly. We will be answering all of your stock queries over the next 30 minutes. But first, let's recap some of the top stories of the day. And here are the headlines. Well, for the markets, 10,500 evades D Street. The Nifty slipped below that crucial mark. It was surging oil's prices, which spooked sentiments. Energy and PSU banks were the main culprits, but IT fell flat. It was pharma that fell flat on its face. IT bucked the trend with HCL Tech and Infi leading the pack.
HDFC Life's 8,700 crore IPO kicks off today. India's third largest private life insurance giant will sell nearly 30 crore shares at a price band of 275 to 290 rupees a piece. Major brokerages recommend a subscribe.
And almost a year post demonetization, a war of words between the Finance Minister Arun Jaitley and the former Prime Minister Manmohan Singh. While Jaitley calls the 8th of November a watershed moment, Manmohan Singh describes it as a flawed idea and a misguided act of course. Those were your top stories. Let's bring on board then our guest who will be guiding us over the next 30 minutes. We have Kalpesh Ashar, financial planner, joining in on the show. Kalpesh, evening and thanks so much for being with us on the show. So much to chat about, but first let's start off with an interesting topic that you brought up. The bull run is on, no doubt. We can see that. It's very evident in the equity markets, but yet a lot of people seem to get stuck on the wrong foot, and there is some sense of underperformance in the equity funds. And I'm sure a lot of investors are scratching their heads thinking, why is that? What would be the explanation? How would you advise them to even sail through times like this?
So what's happened, Avan, is that in the last 1 year or so especially, every fund, in fact I'm talking about only mutual funds, not at the market levels and particular stocks as such, have given an exceedingly good performance. And when that has translated into very good returns, and the returns are really above average. Now what happens in this type of a scenario is that there are certain funds which have drastically underperformed, and those really stick out like a sore thumb. And people who are in fact stuck with those funds are really scratching their head, as you said, as to why am I in the wrong place at the right time, so to say. So there are I think I would say 2-3 main reasons why this is happening. And primarily, if you see, without naming the funds per se, there have been certain calls given by the fund managers or the themes on which they have bet on, which have not clicked in this bull run. And what has happened is that because of their conviction, which has worked in the past, it has not worked so in this bull run. And that is very typical of the fund managers' calls in certain times of bullish and bearish patterns which we've seen, that they give a very hard conviction on a particular theme or a thing. And in this particular case, I would just point out that PSU banks, like they were the laggards completely for last 2-3 years doing nothing, and the reflection of that showed in the fund performance. And very recently, just I think 15 days or one week back, we've seen the recapitalization happening, and all of a sudden there's been a spurt in these funds. But nobody can ignore that the people who were invested in the PSU banks through the mutual funds had seen a high underperformance. The second thing is that many fund houses had taken a contra bet. So because we've seen a one-side upside in all the multi-cap stocks and all the themes and all the sectors were performing, certain contra bets were taken. So like something like an IT or a pharma, which we call defensive. So people who had invested, the fund managers who had taken large calls in them, also saw a certain amount of underperformance. I would not say a negative scenario. So putting that two things together, plus a prominent thing is this is the equity funds which we are talking about. The other important part here is the debt funds. And debt funds, we very well know that they're considered to be a stream of fixed income and all that, and we get better than FD returns, tax efficient returns. But there are certain dynamic bond funds which we've seen which have again stuck to their conviction of the fund manager that they are having a longer duration. And we all know that the RBI has not been cutting rates as per the expectations. So the dynamic bond funds have not given the desired returns, whereas the short-term funds have all been given good returns. So there are again people who have put their money in dynamic bond funds over the last 1 year are again asking questions that even in debt funds, we are facing a certain amount of underperformance.
So in a case like this then, if somebody is stuck in underperforming equity funds, what exactly should they do?
So we go back to the thumb rule of financial planning here, that we are always investing with a certain goal and a time frame in mind. So obviously you would be a tad disappointed that why aren't you in the race when others are. But I think give it a decent 3 to 6 months of review. That is your duty to do it as a very well informed investor, and give it 1 year to I think 4 to 6 quarters in fact before you take a real big decision of flipping the funds, because we have to place ultimately our faith in the very efficient fund managers which we have. So give them that 1 year to 1.5 year type of a time frame, and still there is an underperformance, you're free to decide.
Absolutely, Kalpesh. So importantly for our viewers, it's very important to go through your portfolio and review your portfolio every 3 to 6 months at least. But moving on now, our first question comes in from Chinmay Kulkarni, who sent us an email. Says, I'm 24 years old. I started investing in mutual funds from the age of 22. I've got 2 goals: purchase house at the age of 36 or 37 for around 1 crore, and also to accumulate around 3.5 crores for retirement. Every year I plan to increase my SIP amount by 10%. I have a monthly SIP of 10,000 in the funds that he's mentioned, and he's asked to review the portfolio. Now, among the funds he has Tata Equity PE, Franklin India Prima, Reliance Tax Saver, as well as SBI Blue Chip. Kalpesh, what would be your advice for him? He has very clear-cut goals and clear-cut, way to increase 10% of his SIP on a regular basis. Do you think these goals are achievable? What is your analysis?
So he's investing very young.
Yeah, so that was the first part of my answer. In fact, that congratulations to him. In fact, he's 24 and he started when the age was 22.
Yes.
So the due credit to be given to him. And he's been doing SIPs for 10,000 rupees. First of all, on the SIP portfolio which he is having, I think out of the 4 funds, 3 are absolutely fine. I would just recommend that instead of the Tata Equity PE, he shifts into Aditya Birla Sun Life Equity Fund, which has got a better pedigree and a better track record going forward. So that is the only change. Now coming to his goals, he's got 2 goals. One is of the house purchase, which he's envisaged after 12 years. And the other one is obviously his retirement. Now, one thing which people forget when they do their goal planning, albeit that they do it in true spirit, I would say, is that they don't consider inflation and they don't consider a future value. So if he's put 1 crore as an amount which he is looking at after 12 years, I'm sorry, but I think that will be far less of what he would be requiring after 12 years. But even if 1 crore is a future value, if he requires after 12 years to purchase a house, he would just be required over a period of time to increase that SIP to almost 30,000. That's a big ask. But that is the arithmetic calculation to buy a house in the next 12 years. If that investment grows at a moderate 12% per annum in equity-based mutual funds, that's not asking for much. But the good side of it is that on the retirement part, that he is 24 right now and he's got a very decent 30 years of his working life ahead of him, and obviously investing aspect also. So even if he were to not take into account what increments he were to get, but the power of compounding is so tremendous that if he were to put this 10,000 per month for the next 30 years and again giving a moderate 12% per annum, on the retirement front he would be able to accumulate 3.5 crore rupees approximately just by being disciplined and sticking to this amount.
Okay, that is the outlook, and you gave us the view what he should do with those individual funds, and even for some of those existing investments, what exactly would you advise him to do, Kalpesh?
The existing investments, as I said right now, that he is in fact intending to increase it by 10% once his income grows. So he just does that small flip which I suggested, and I think he's on his way because he's got a tax saver fund also with him. He's got a large cap, so it's perfectly poised for a good portfolio.
Okay, one switch in the portfolio. Otherwise, Franklin India, Reliance Tax Saver, SBI Blue Chip, good mutual funds to be invested in currently. All the very best, Chinmay, and our congratulations for taking the initiative, starting out early and putting your money into mutual funds. Well, let's go on board to our next query, and this one has been sent in to us via email from Mahesh. He says, I'm a 50-year-old NRI. I'm planning to retire and return to India. My retirement corpus has been built over the last 20 years. Fixed income of 1 crore rupees. I need around 1 lakh rupees per month as monthly income after my retirement, growing at 8% every year for the next 20 to 25 years. Would I need to change my current portfolio after retirement in order to generate the expected income? And let's find out some of the stocks that he currently, some of the mutual funds that he has currently. HDFC Top 200, ICICI Focus Blue Chip Fund. He's also got Birla Sun Life Frontline, IDFC Nifty Index, HDFC Mid Cap. There's ICICI Mid Cap as well as IDFC Premier, Kotak Emerging Equity and Reliance Small Cap Fund. What's your advice and any rules when it comes to NRIs and, returning to India with respect to their savings in mutual funds?
So, Avan, let's address the financial planning part of it first. And this gentleman, in fact, is 51 and he's planning of a retirement and coming back to India. So, on that count, when we say about retirement planning, be it an NRI or be it a local individual, the thought process remains the same. Retirement planning is a very serious and a thought-provoking process. It's built up of various factors and it needs to be done early. All the factors which we keep in mind is generally the present and the future expenses, the inflation, then your existing investments, and most importantly is what is going to be your regular source of income once you retire. So I think that is very important to be factored in. And I don't think those type of exercises Mr. Mahesh has done thus far. But whatever he is mentioning right now, let's talk about that. And answering your question, Avan, is that for an NRI, when he comes back, obviously the taxation rules and everything becomes more applicable to the resident part. Post 6 months he is in India. So he will have to look at the Indian terms and conditions of the taxation part and the investments, obviously. Now, the funds which he has right now is a very large array of funds. And when we have a portfolio of equity-based mutual funds, generally, I do not recommend more than around 5 to 6 funds in your portfolio. And he's got a whole host of funds, so he can trim down because there's no point in overlapping, say, one multi-cap fund by having 2 more in it or 1 large cap. I think 1 in each category does the job for you. So a little bit of trimming in that portfolio. Otherwise, even this portfolio, what he's chosen is, I think, 80 to 90% pretty decent. Now, when he says that he requires a regular income of 1 lakh rupees per month when he retires, again, that is just a wild guess which he's come up to because there's a lot of calculation which goes behind it. But to at least do that, which comes to 12 lakh per annum, and to get a 8% return, he would need to invest around 1.5 crore in a product which gives him 8% type of a return on a regular basis. And unfortunately, with the present scenario which we are right now of the fixed income interest rates on the decline, especially the bank FDs and all those things, I think it's better that he has an allocation of 60% in debt-based mutual funds and 40% in equity-based mutual funds. That also he needs to have it in a dividend payout mode or an SWP in certain cases, which will give him a regular flow of income, and he has to do asset allocation. He cannot turn a blind eye to it. The other thing is that I think if he retires at 50, he's got a challenging time ahead because he needs a pretty decent corpus to really build up, because we always take a life expectancy of anything 80 years and above. So he's got another 25 to 30 years of life expectancy to plan for the current lifestyle to be adhered to. So Mr. Mahesh, to summarize, I would suggest that although your retirement intention is good, but I think your portfolio or your corpus might be insufficient to support it.
All right, Mahesh, well, hope you've got that detailed analysis from Kalpesh. But as far as the funds that you hold, it's all got the green signal from Kalpesh. But time now for a quick break. But before that, we'd like to tell you that The Money Show will bring you a very special episode on the 14th of November. That's Children's Day. So if you have any questions with regards to the investments for your children, what kind of goals you have, how you should go about planning them, even if they're very young, the earlier you start, the better, as all financial planners say, send them in to us. You can call us on 022-2483-7177. You can send us an email on themoneyshow@etnow.tv. You can even tweet in your queries at ETNow Live, and we'll have Feroz Aziz, the Deputy CEO of Anand Rathi Wealth Management, with us to answer all of your queries so that you can give your child a healthy future.
Thanks for staying on with us. You're watching The Money Show, and yes, in our studios, Kalpesh Ashar, financial planner, helping you out with all your questions and queries. Remember, this is on mutual funds, on insurance, tax, or even opening a bank account. So let's get straight to the next query then that we have, and this one is an email query. It's been sent in to us by Gajendran. He says, I have been investing 5,000 rupees monthly in Tata Balanced Fund and Birla Sun Life Frontline Equity Fund via the SIP route. This is for the last 1 year from March 2016. He's saying last year both the funds' performance was below the benchmark. Should I exit these funds or hold on? Do you have any recommendations as a replacement? Well, what's the advice that you have for Gajendran? Because he seems to be, do you think, a little bit impatient in these mutual funds? What's the advice?
No, I think impatience is not the word, but as I said, that people are exuberant in this market. So these two funds are genuinely very good funds, and they have a very good pedigree. And in their own categories, they have been leaders. And especially the Tata Balanced Fund, we all know, and Gajendra's observation is absolutely right, it has been an underperformer. But I would seriously not recommend any exit from that particular fund. And as we covered in the first segment, you know, there are certain areas in a fund when a fund manager takes a call and unfortunately that has not worked. That does not make the fund per se a fund which you need to leave out of your portfolio. Coming to Birla Sun Life Frontline Equity Fund, I think it's a very good fund and a benchmark in that large cap category. So please stick to these two funds, and I'm sure there'll be a turnaround. Yet you can take your discretionary call, but hold on for another 6 months, 2 quarters, review it. And in case you need to flip out of the Tata Balanced Fund, which you're looking at, then I would suggest is you can look at the HDFC Balanced Fund or the Reliance Regular Savings Fund Balanced Plan.
Right, but Kalpesh, when should he decide whether or not to switch out of the Tata Balanced Fund, like you were just saying?
So he's, I think, in it from the last 1 year, 1.5 year.
Yeah.
So that's what I said, 6 months more. So you have a decent 2 years review, which you've done for that. And then he can move out of it, because ultimately it's a balanced fund.
Right.
So then moving out from one balanced fund to other, it won't hurt his portfolio much. So that's okay. A 2-year period is good enough.
All right. Well, that was the advice coming in there. But our next question comes from Prashant Cheda, who says, I've invested a lump sum of 50,000 in a mid-cap fund in Jan 2014 and my investments have doubled. I wanted to understand how expense ratio is calculated for a lump sum investment. Please explain. Kalpesh, how should he go about doing and ensuring that the math that he does is correct?
So first is the exuberance and the happiness part, that his money has doubled in 3 years. And that's what happens with typically the mid-cap funds. They really are the racers in the bull market, and that's what has happened. So good for him. He can hold on for it if his goals are not anywhere near. And coming to the expense ratio, I think that's a very relevant question for all the investors to understand, that what are they being charged. So when we say an expense ratio in a mutual fund, it is nothing but the fund's cost of managing your particular mutual fund. And how is it calculated? The arithmetic behind it is that it is calculated by dividing the fund's total expenses by the assets under management. And when you say what are those expenses, it is basically the management fees which the fund derives, the legal expenses, the distributor commission in case of regular plans, not in direct plans. Then you have also the custodial charges which they have, plus the normal administrative charges and all the other things. So those are the expenses which is calculated in the expense column. and the assets under management is the current market value which that particular scheme has. So be it an equity scheme of the holdings it completely has in its scheme. So that is the expense ratio for you, and it's good you asked this question. So lower the expense ratio, it has a better effect on your returns.
All right, that's the outlook coming in. I hope you've, understood how to do the math right, how exactly the expense ratio is calculated. Well, actually, Kalpesh, we've got a live query right now with someone who's connected with us all the way from Singapore. We have Hari with us who joins in on the phone line. Thank you so much, Hari, for being with us on the Money Show. What is the question that you have for Kalpesh?
Yeah, my question for Kalpesh is, I am an NRI based out of Singapore. I have a lump sum of 30 lakhs to be invested. I wanted to understand what route should I follow to invest that corpus, and what's the procedure for an NRI to be investing in mutual funds, and if he can suggest me some good funds to invest this corpus for a tenure of 7 to 10 years.
Yeah, this is something that we were discussing, Hari, at the start of the show as well. So any challenges for an NRI while investing in India, and what funds would you recommend for him?
Okay, so first the entry part. So as an NRI, I think you need to get your KYC and your FATCA regulations under place. And after that, you need to give, for your KYC to be done, you'll need to get your exactly your passport copies and all the PAN card copies, your OCI, if you're a resident of Singapore, in place. Once you do, the compliance part is taken care of, your KYC and the FATCA, you're about to start the mutual fund journey. And when you do the mutual funds, I think, I'm sure you'd be having an NRE or an NRO account, and the NRE account which you have will have the facility to repatriate the money back to Singapore in case you require it. And we always suggest that it's done through the NRE route. So you always have the exit door with you, and it is easy to maneuver the funds also into the investment part. Now, once the NRE and the NRO accounts are open, then you can invest in the normal local mutual funds, and it's good that you have a good time horizon which compels you to put your money into equity. And the 30 lakh amount which you mentioned, Hari, right now, what we would suggest is that because the markets are really going upwards on a day-to-day basis, you park your money first in a liquid fund, in a debt fund, and from that you probably have 3-4 debt funds or liquid funds of 3-4 various mutual fund houses, AMCs as we know them, and do a STP, which is a systematic transfer plan, into the equity funds, staggering your investments over a period of say next 6 to 12 months. So by that you will average out your money will be in the Indian capital markets, in the debt funds for sure, and from there, if you have a 7-year view, I think you will be quite well off having very decent returns over that time frame.
All right, Hari, thank you so much for calling us with your question. You too can connect with us if you have any questions. But with that, it's a wrap on this show. Thank you very much, Kalpesh, for joining us and answering all those questions. From Avan and me, that's a wrap. But here's a quick reminder for our special 14th November show, where we're going to have Feroz Aziz of Anand Rathi joining us for a special Children's Day episode, where you can ask us any question you may have with regards to financial planning for your child's future, and we'll have them all answered. So do write into us. You can either call us, write into us, and connect with us either on Facebook or on Twitter.